I think that this decline in interest rates was the biggest single event of the last 45 years in the financial world. Most people wouldn't say that. Why? Because it was very gradual over a long period of time. You could be criticized for buying quality that was too low. And in fact, under the right circumstances, if a fiduciary bought 10 risky assets, if 9 of them were up 10x and the 10th one lost 5%, the fiduciary could be surcharged for having bought a risky asset and made to pay. So the job of the fiduciary was to avoid low quality. Then around 77, 78, Michael Milken and others had the idea that the prohibition on issuing below investment grade debt was excessive. And rather than consist of a blanket prohibition, there should be an understanding that they're risky. Because they're risky, they have to appear to offer a higher return as an inducement. But if the promised return seems adequate for the risk, then that's a reasonable thing for a fiduciary to do. So this was a big change. But this was a sea change, you know. You go from there are good assets and bad assets, and you can't buy bad assets, to you can buy any asset, no matter how risky it is, as long as as a prudent professional would say that the prospective return compensates for the risk. Big change, risk return thinking. And I dare say that it's risk return thinking that governs everything we do today. And nobody declines to buy anything just because it's low quality, but because it's too risky for the return that seems to be offered. Big change. And we wouldn't have hedge funds, venture capital, private equity, and all the derivatives at the institutional level if the old fiduciary rules were still in force. So the shifting to thinking about risk and return together really has made the investment universe of today unrecognizable from 50 years ago. The other sea change I lived through came right around the same time, not connected, I don't think, by anything underlying. But in 1980, I had a loan outstanding from a bank in Chicago, and they sent me a slip of paper, as they did when rates changed, and they said the rate on your loan is now 22.25%. 1980, December. 40 years later, I was able to borrow at 2.25% fixed for 15 years. Well, this is a major change. And first of all, declining interest rates have a number of very strong impacts. They stimulate the economy. They make it easier for companies to make money. They make assets worth more. And of course, they reduce the cost of borrowing. So these events of those 40 years made it very, very attractive for asset owners and for borrowers. And people who borrowed money to buy assets got a double bonus. And so this was the overwhelming condition over this period. And it's not a coincidence that this is when private equity, and in particular, had its great success, because that's what it does. You borrow money to buy assets. The assets as it happened, turned out to be worth more than you thought they would. And the cost of borrowing to buy them turned out to be less than you thought it would be. Now, what a great combination. And I believe there's a couple of things worth noting. Number one, I think that this decline in interest rates was the biggest single event of the last 45 years in the financial world. Most people wouldn't say that. Why? Because it was very gradual over a long period of time. Kind of like the frog in the pot of water. You know, you put a frog in a pot of boiling water, he'll jump right out. But if you put him in a cool water and you turn on the heat, he'll just sit there while it gets hot, and eventually he'll succumb because he doesn't notice that it's taking place so gradually. And I think that's what happened with rates. They changed so gradually that people, I mean, if you sent out a questionnaire, what was the most important event in the last 45 years in the world of finance? I don't think anybody would they would say derivatives, high yield bonds, private equity. Very few, I think, would say the decline in interest rates. But and then so a couple other things worth noting. Number one, that means that in order to have seen a more normal period, you had to be working in the 70s or maybe in the 60s. In the 70s, of course, we had the battle against inflation, so that wasn't a typical period. The 60s may have been something we would call normal. But that was obviously, the 60s ended 53 years ago. So not too many people who worked in the 60s are still working today. And I believe that the declining interest rates were responsible for the majority of all the money that's been made in the last 45 years. So that's pretty important. Those are my candidates for sea changes. Obviously, not just a normal cyclical up and down, not just a correction, an excess and a correction, but a replumbing of the whole environment.
So the environment of borrowing money and buying assets, the low interest rate period, seems to be reversing. So what is the opposite of that? What is the sea change we are entering into that you're foreseeing?
Trey, I'd rather not say reverse, because that implies that we're saying rates went down and now they're going to go up. I would say they went down and now they're going to kind of hang around at this level. I'm not predicting that they're going to go back up. And in fact, you look at the Fed funds rate, which is 4.75% today. I'll bet you in a year and a half it'll be lower. The rates are high today to fight inflation. I don't think they're going to stay this high or get higher. But if rates are through coming down, well, two things. Number one, they're through coming down. And number two, they're in any major way. And number two, they're through being ultra low. The Fed reduced the Fed funds rate to zero at the beginning of 2009 to rescue us from the global financial crisis. And it worked. And it was a strong move. And we should thank our stars. But interestingly, do you know how long they kept it at zero?
13 years.
No, and most people don't know. And the answer is 7 years.
7 years.
Now, zero rates are an emergency measure. And an emergency measure was called for in late 2008 or early 2009. But clearly, we didn't have an emergency for 7 years. Clearly, by 12 or 13 or 14, the emergency was over. So why were rates left at zero? And the answer is, I'd rather think it was a mistake. But anyway, so if rates aren't going to be ultra low and aren't going to decline in the future, then the things that worked in recent years should not be the things that work best in that new environment. That's the essence of the memo sea change.
So I'm tempted to ask, where if you think there's a Volcker-like, hammer needed here with this current inflationary environment, because you said they're not going to stay low for long, they're not going to go high for long, but inflation seems to be sticking around, and that playbook exists. I'm just curious if you're agreeing that maybe that's not needed in this new environment.
Well, I think it's not needed to the same extent. First of all, inflation today is probably roughly half of what it was in the 70s. So we by definition, we don't need as strong countermeasures. And secondly, some of the inflation that we have is kind of a one-off response to the post pandemic measures that were enacted, distributing so much money to taxpayers and so forth, and also the little crimping of the supply chain. And those two things should work themselves out over time. So I think that the level of inflation today is not so high, and it will abate naturally, which was not necessarily the case in the 70s. But we still need to wipe out inflation and inflationary psychology, which tends to get embedded and sticky. And I think that you asked whether we're going to have a Volcker type treatment, and I think we are getting it from Jay Powell. I think he's being very reasoned, but he's being resolute. And all the optimists who run the stock market would love him to say, we're probably going to think about bringing rates back down starting in December or something. But he hasn't said it, and I don't think he's going to say it. And all he has said so far is we're going to keep raising rates. We may go slower than we were going. We may end up higher than we thought we were going to go, but we're going to keep vigilant. And he hasn't said a word. Well, he has. He has mostly said, and we're not going to be cutting rates anytime soon, which I think is very appropriate. So I'm optimistic that he'll do the right thing here.
Then they've been coming up with all kinds of tools that I think will kind of abate them needing to lower rates as well, which is kind of fascinating. When interest rates are low, corporate defaults are also low, and as rates rise, defaults also rise, or they tend to rise, right? So you've written about investing with caution in the past while we've had this pandemic-infused uncertainty and this low return on cash environment. I'm curious how your opinion on investing with caution has changed in recent months. Is it the new definition of caution to a degree, or a different type of caution that you're now investing with?
Well, there are lots of kinds of caution. And for me, caution means insisting on a margin of safety. Not many of us are so dumb that we'll make investments that would suffer if things stay the way they are. But if a cautious investor insists on margin of safety or margin of error, whatever you want to call it, what he's saying is, I want to make sure that if things get worse than I think they will, I'll still be okay. And so I think that that's a very important part of being a cautious investor, because, from time to time, things will be worse than you had thought. How will you do? That's a key question. Now, when the market's flying high and valuations are stretched and all opinions are loaded down with optimism, clearly you need a lot of caution, because there's so much potential for things to come in worse than expected. When the market's really low in its cycle, there's not much risk of that. There's no optimism in prices. Nobody thinks anything good is going to happen. So you're not at risk of overestimating the situation and being disappointed to the same extent. So the thesis of mastering the market cycle is that your actions should be determined by where the market stands in its cycle, to the extent you can figure that out. And when it's high, you should be cautious. And when it's low, you should be aggressive. I still feel the same about that. At Oaktree, we have, I would say, a cautious bias. Every investor and every investment portfolio embodies a mix of aggressiveness and defensiveness. Well, you say, I want to be a defensive so that if things go badly, I won't suffer too much. But on the other hand, I don't want to miss all the opportunities, so I'm going to have some aggressiveness. And the question of how you strike the balance between aggressiveness and defensiveness, for me, is question number one in the short or intermediate term. And when the market is, I think the market's in moderate territory, so I'd like to keep the same in their normal balance, which for Oaktree means a cautious balance. We charted our course many years ago as saying that what we're going to deliver is lots of good years, maybe an occasional great year, but hopefully never a terrible one. And if you can just do that combination, which I think we've done, and you can do it for 40 or 50 years, then I think you've really accomplished something.